There's no doubt that silver's weaker than gold. And the reason there is clear is that China's still not recovering well. The industrial side in the US looks like it's slowing. So it has that dual side. It's a store of safety, but it's industrial metal. We did break this key level of support, which to me tells me silver is likely headed to about $26. But I still think in the scheme of things, as long as we don't break below this former kind of consolidation zone, I actually think it's a buying opportunity on silver. And I do think that eventually, it just may take time because of the economic implications for silver, but eventually silver does continue up. And I still think that $48, $50 level from about a decade ago eventually will be tested.
In recent market developments, precious metals have shown divergent trends, capturing the attention of investors and analysts alike. Gareth Soloway, a prominent financial analyst and chief market strategist at inthemoneystocks.com, maintains a bullish outlook on gold and precious metals despite recent volatility. Traditionally viewed as a safe haven asset, gold experienced a roller coaster ride last week. It initially surged to record highs, buoyed by economic uncertainties and expectations of continued monetary stimulus. However, the yellow metal retreated sharply, falling as much as 1% daily. This recoil was primarily attributed to a broader market sell-off, which prompted investors to liquidate gold positions to cover margin calls in other assets. Soloway's optimistic stance on gold is rooted in macroeconomic factors. He cites anticipated money printing and a lack of government fiscal responsibility as key drivers for potential long-term appreciation. Despite short-term fluctuations, Soloway believes the underlying bull market in gold remains intact. Silver, gold's more volatile cousin, faced even more significant turbulence. The white metal plummeted 6% in a single session, underscoring its heightened sensitivity to industrial demand and investment flows. Silver closed down 4.42% for the week, significantly underperforming gold's modest 0.57% decline. This stark divergence between gold and silver highlights the complex dynamics in the precious metals market. Silver's dual role as a precious and industrial metal makes it particularly susceptible to economic concerns and shifts in risk sentiment. Despite the near-term bearish pressure, Soloway remains optimistic about silver's long-term prospects. He anticipates that silver could eventually test its decade-old highs near $48 to $50. Although he cautions that this move may take time due to ongoing economic uncertainties and industrial demand concerns. Please tune in for our exploration of Gareth Soloway's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
It's still a bull market, and I still think it goes a lot higher. So yeah, you've gotten a pullback here, but again, the longer term fundamentals are printing of money will resume. The government is not even close to being fiscally responsible. All of those factors are bullish for gold and metals, precious metals in general. But having said that, you still have a trade that needs to digest. So just like Bitcoin, right? We had this big move to the upside, and now you're kind of going sideways like this. And that's very normal. In fact, the best example of this you were bringing up on Bitcoin back in 2019, but let's just go back here. Go back to 2018. Look at that move, and then look at all this digestion that was going on in gold until the recent breakout took place. And so for me, I look at these patterns because they repeat over and over again because human nature doesn't change in terms of greed and fear. And when you see something like this happen in the past, chances are it will happen again. And I believe at least that is what is happening here. You're getting that digestion before your next move up. There's no doubt that silver's weaker than gold. And the reason there is clear is that China's still not recovering well. Industrial side in the US looks like it's slowing. So it has that dual side. It's a store of safety, but it's industrial metal. We did break this key level of support, which to me tells me silver is likely headed to about $26. But I still think in the scheme of things, as long as we don't break below this former kind of consolidation zone, I actually think it's a buying opportunity on silver. And I do think that eventually, it just may take time because of the economic implications for silver, but eventually silver does continue up. And I still think that $48, $50 level from about a decade ago eventually will be tested. So you've seen the PMI data lately. And again, the PMI data has shown that we've generally been shrinking in that side. We've seen the jobs data starting to get weaker. Jobless claims were about 3 months ago averaging around 215,000 per week. We're now up to about 235 on a weekly average. So lots of signals are showing slowing. In addition, I think we just have to look at like delinquency rates, right? When you have delinquency rates at levels not seen on credit cards, on auto loans since 2010, that is a signal that there is a huge group in the US that already feel like they're in a recession, whether it's high costs from inflation or just kind of a lack of new opportunities for them. There's definitely this feeling that a portion is already in recession. Historically, and again, it's important to go by the data. Historically, the stock market starts to fall dramatically when the Fed starts to cut rates. It's when the Fed is thinking about it and the market is hoping for it that we go up, which is what we've seen over the last, 3, 6, 9, 12 months. But reality is that we get a market that falls when they start cutting. And the thought process there is that investors worry that the Fed is behind the curve at that point, that once the Fed is forced to cut, it's already going to be a hard landing and the Fed needs to do more. And the Fed is going to be very measured on these cuts unless things get really out of control. It won't make the markets happy. It won't make investors happy. So I think that's the key in that respect.
In a notable turnaround, U.S. stock markets closed significantly higher on Friday, marking a recovery for the tech sector and providing a positive end to an otherwise challenging week. The Dow Jones Industrial Average surged 654 points, or 1.6%, while the S&P 500 and Nasdaq Composite gained 1.1% and 1.0% respectively, breaking their three-day losing streaks. This rebound was primarily driven by a resurgence in tech stocks, with industry giants such as Nvidia, Apple, Microsoft, Meta Platforms, and Amazon all posting gains. The semiconductor sector also saw broad-based strength, with the iShares Semiconductor ETF climbing 2.1%. The market's upward movement was further bolstered by encouraging earnings reports from several companies and inflation data that reinforced the Federal Reserve's expectations of imminent interest rate cuts. This combination of factors helped alleviate recent market pressures, although the S&P 500 and Nasdaq still finished lower for the week. However, despite this positive turn, some market analysts, including Gareth Soloway, maintain a cautious outlook. Soloway, in particular, believes there's still potential for further downside, especially among large-cap tech stocks that have experienced sharp rises in recent months. Let's get back to the interview.
If you think about it, since 2009, every pullback's been a buying opportunity. In fact, we haven't even seen pullbacks of this magnitude. I think we're down about 8% on the Nasdaq 100. And there haven't been pullbacks of this magnitude really since what we saw in 2022. And so conditionally, investors have just thought, okay, just buy every dip. If this was my chance to get in Nvidia, it's pulled back 20%. These are the opportunities. And that kind of lulls people into buying the dip. And you also see, decent news on PCE data. PCE data came in line with estimates. That kind of lets out a sigh of relief. But when it comes down to it, the big cap tech stocks have gone vertical to such a degree that there's more reversion trade to go. And we've seen the Russell. I mean, the Russell has just catapulted to the upside because it was left behind. Eventually, both those indexes will go down together. And again, this is clear. And I want to show a couple things. So let's remove these lines that I have on the chart. And I want to show a monthly chart of the Nasdaq 100. And I'm going to take a parallel. We're going to take the low from COVID and we're going to connect it to the bear market lows of 2022. And I want to show you this parallel trend line. And this is where technical analysis is just mind blowing. And what we could see here is that if you take the low and connect it to the bear market low, so COVID low to bear market low, stretch a perfect parallel up, look at the high bull market of 2021 and look at what we tagged on the charts just in the past month. At the all-time high, we tagged that trend line. Now, as a technician of the charts, what do I know? Well, I know the last time we hit this line, we had a massive sell-off. So it makes sense if you extrapolate that out that we should see a big sell-off in the Nasdaq. In addition, month is almost over, right? Next week, I think Wednesday is the last day of the month. You're getting what's called a topping tail formation here on the monthly chart. That is a bearish reversal signal, a sign of a top as well. So the technicals, data-driven, back-tested, this is what it's telling us. It's this correction here from the high of 2021 back to the lows of 2022.
Right. And
yeah, so that was a 30 on the Nasdaq 100. That was a 38% drop. And so what you do is you figure, okay, well, if we do come back to this lower level, how much of a drop would that be? And we take the high and we drop it down, and that would be about a 35% move, mainly because the stock market's higher now. So the same drawdown would be slightly less in percentage terms. So I think that again, I should say about 12 to 18 months out, just like the last one, you would expect about a 35% drop in the Nasdaq. So a couple things. And then you're drawing a good point here. So number one is that human emotion doesn't change, right? So when you were bullish and euphoric in 2021 and markets were going up, it seemed like markets could never go down. We saw GameStop run, we saw all the meme stocks and all that craziness go on. That bullish greed is exactly what has driven up these mega caps. And in fact, GameStop did run again just a month or two ago, right? So we've seen that same sort of thing. And so human nature is that way, and that it tends to repeat greed and fear, greed and fear. It just happens at different levels on the charts. And so I want to just point that out. The other thing is that you're right. In 2022, the fear was, oh my goodness, the Fed is going to tighten too much and cause a recession. We're now going to be entering a point is, oh my goodness, the Fed's not cutting enough. We're going to have a hard landing and a recession. And it's ultimately the same end game of that recession that's going to cause a slowdown in profit growth that will drive down these valuations of these crazy mega caps.
Given the recent divergent trends in precious metals and the notable volatility in both gold and silver markets, with gold experiencing significant fluctuations yet still being seen as a safe haven asset, and silver showing even more substantial turbulence due to its dual role as both a precious and industrial metal, what are your thoughts on their future trajectories? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.